Sustainable.
Insurance companies were ridiculously hit, banks were seriously hit, and then investors went from wealth to debt. And you have to think about what the psychological impact of that. One day you're worth 100 million, the next day you're worth negative 80 million. And all this happened in the space of 10 months.
The seeds of the market downturn were sown in the years prior to the 2008 peak.
The market was going up, and so everyone wanted to take part in the market. So you had those who, through the stock exchange, were able to list and also raise money through the stock exchange. And then you had situations where they had a flurry of private placements. It's estimated there were hundreds of private placements done, the lack of liquidity, where for a lot of the people who took part in it, they were promised that there was going to be listing, which some of them had not listed, so the illiquid. Even some of the projections, you look at the financial projections a lot of those companies made, even those that were listed on the exchange, some of the projections were just outlandish. But the market had this confidence in the market, and so it just seemed like it was never going to go down.
In 2007 to early 2008, what we really had was the proverbial bonfire of the vanities. Private placements were, the issuances that were hitting the market were generally lightly regulated, and investors were investing based on nothing more than past experience in other investments that in a lot of times were unrelated, and the level of scrutiny of investments was very low. On the flip side, you had banks that were awash with capital that they had to put to work, and for them it was a no-brainer to do.
Price manipulation. You saw companies that are about to go into the market, showing that share price started moving up. You saw the allegations of insider trading, opaque, lack of transparency within the market, and just brokers selling clients stocks without informing clients, just various kind of infractions, which there seem to be no regulatory punishment.
A global financial crisis and attempts by the NSE management to stem the tide only added more impetus to the bear run.
It happened to coincide with the foreign markets collapsing, and a lot of people a lot of international fund managers having to pull out of Nigeria, even though they didn't necessarily want to. Their books were being so hammered offshore that they had to actually sell stocks that they had a profit in. The stock exchange itself did not handle it very well when they started trying to put circuit breakers in place at 1% per day. Those don't work. When the market's going to go down, all they did was extend the pain over 9 months, which could have happened over 2 or 3, and I don't believe the market would have fallen as much had they not had the circuit breakers in place.
With investors' confidence at its lowest ebb, authorities in Nigeria's capital market had to begin the tough task of cleaning up the mess.
On the back of the crisis of confidence, I think people, first of all, did not recognize that the investor is king in the capital markets. And so establishing, first of all, a shared objective for the capital markets, which investors can connect to, capital market operators can connect to, and we, as the regulator, can lead, was very, very critical. That objective was to build a world-class capital market, because a world-class capital market is one that, first of all, has as its anchor integrity. And some of what we suffered was just not the global financial crisis, but the crisis of confidence was coming from some level of market abuse. So we had to reestablish that this is a market where, as a regulator, we would not permit infractions, that we had zero tolerance for anything that was improper.
Okay, so we saw the reform objectives. Run us through some of the actions we've seen you take since then.
You will recollect that in 2010, there were 2 very widely publicized enforcement actions that we took. The first one was with respect to the intervened banks, where we alleged that there were a variety of market abuses, and it led us to take 260 individuals and entities to the Investment and Securities Tribunal, essentially the court, for issues related to the capital markets. The second one related to the Nigerian Stock Exchange. The Nigerian Stock Exchange is the most visible symbol of our capital markets, because stock exchanges are the visible symbol of any capital market, and ensuring that it was operating on the basis of world-class, on the basis of best practice, ensuring that the leadership understood what it meant to build a world-class market, that if there were any instances or corporate governance weaknesses or malfeasance, that was behind us.
A key element of the changes was the appointment of a new leadership for the Nigerian Stock Exchange. Emmanuel Ikazobor was appointed as interim administrator in August 2010 to start the process of cleaning up the bourse. Subsequently, former Wall Street executive Oscar Onyema was appointed as the substantive CEO in April 2011 to drive and develop a long-term vision for a world-class stock market.
One of the first things we said is that we're going to set out to build a very solid foundation for the Nigerian capital market. A solid foundation means that there's a lot of hard work to be done, and it's a multi-pronged approach work that needs to be done to build that foundation, because it's the medium long term we're looking at. A capital market is not a quick fix, get rich quick scheme. Yeah, it's got to be a fundamental part of our national economy. I can remember very clearly when we started, we looked at the compliance levels in terms of reporting for companies. Yeah, and we found that a significant number of the companies listed in the exchange were actually not reporting within the timings that is required. Yeah, and how can investors actually have a fair discovery of price if indeed information is out of date? That was fundamentally impacting confidence. So one of the things we did then was actually we identified the companies, we spoke to them, gave them a deadline, because I thought it was important that we actually work hand in hand. And those that required support, we gave them the support required to actually come up to speed. But it comes to a point where a regulator has to act as a regulator. Yeah, and we suspended 48. People thought, no, you can't do that. And we said, well, just what we've done.
In addition to introducing new products such as exchange-traded funds launched last year, other elements of a 5-year plan include the introduction of derivative products such as futures and options. One of the most exciting initiatives of the NSE this year is the takeoff of market making.
If you noticed last year when we started, one of the things we did within 3 months was say, these are what we're going to deliver in 2011. Yeah, there were some things within our control, things outside our control. We're not going to give a hand, throw our hands up, but we're going to advocate. And I'm really pleased to say the staff of the exchange, the wider market, have supported us, and we've delivered on the 2011 agenda. We launched the first ETF in West Africa. That's doing pretty well. Amongst other things, we revamped our website. I think that's phase 1, by the way. It's more accessible, more user-friendly. People can get more information. We've got phase 2 and phase 3 coming down the line. And we've looked at the market structure that we had at that time, which is still part of the fundamental building block, was just not the right market structure.
Because at the end of the day, it is the structure of the market that is going to drive the health of your market. What we saw in 2007, 2008 shows us exactly what happens when you have a market that is not ready for what it's doing. What the current leadership of the stock exchange, Oscar Onyema and his team, are doing are exactly what we need. Because if you create a system that has the right structures to handle international investors, to create the kind of liquidity that's necessary for people to move in and out in an orderly fashion, that way a lot less value will be destroyed when people leave.
The initiatives such as securities lending, short selling, market making, and we can expand that into cost of doing business in our market, and quite a number of other ways that broker-dealers interface with the wider market participants. But specifically with market making, securities lending, short selling, several attempts have been made to start this in the past, but it's quite a heavy lift. We wrote the rules working with SEC from scratch for those 3 requirements. We got the rules approved with a lot of input from market participants. And as you remember, in April this year, we announced 10 market makers in a very